Just a little background about myself. Not only am I CEO of CBD Spa, it's one of our subsidiaries. I own a portfolio company called Nature Secret Holdings that holds 7 different subsidiaries. Six of them are CBD related. And we've been building that since December and really scaling out from there. So I'm going to quickly hit the panelists and let them talk a little bit about themselves. So we'll start out with Michael.
Thank you. My name is Michael Brubeck with Centuria Foods. I guess notable things of interest for this panel. Been in the legal cannabis industry for 15 years. I started the first cannabis fund, a $10 million fund in 2007. Started 14 dispensaries with a liquidity event in 2009. And then I've built my existing company today entirely on debt vehicles, which is currently constructing a 100 million gallon per year extraction facility.
All right, Brandon.
I'm Brandon Holmes. I'm the CEO of Dan Hempworks. We're an early stage CPG company in the natural food space. A water soluble beverage additive that's also served on premise, and we're in the position of formulating the building blocks around protecting our IP, building the brand, and getting to know our customers to then position the company for a merger, acquisition, or an exit event.
Brett?
I'm Brent Johnson with the Open Law Group. We're headquartered in Denver, Colorado. Let's just do that. So Hope Law Group, we're headquartered in Denver, Colorado. We're one of the nation's leading full-service business law firms serving 100% cannabis businesses. We do anything from corporate transactional work to intellectual property, tax, real estate, employment law, pretty much anything a business or an investor in this space would need. I'm officially a 20-year attorney. Started my practice in Silicon Valley 20 years ago. Worked with a lot of startup companies, early stage companies. I've done tons of deals on VC, M&A, IPOs, etc. I'm about 3.5 years new to the cannabis space, and it's been super fascinating, and it's great to kind of apply my skills and expertise to the space.
And Derek?
Hi, my name is Derek Duchesne. I am the Chief Growth Officer at EcoGen Laboratories, the largest hemp producer and processor in the United States. Previously, before joining the company, I helped build a handful of CBD brands, started running their supply chain and marketing. One was recently acquired for $1 billion. I've helped raise funds for a handful of companies, including the $80 million fundraise that EcoGen is about to close, and have worked with every sort of whether it's debt financing or private equity or VC funds.
Awesome. So got a great selection of panel here, and I think we have a little bit of extra time, so we're going to utilize every second of it because I think this is definitely needed. So just for the abstract, Israel is called a startup nation because there's the highest number of startup companies per capita in the entire world. In their book by the same nature, Center and Singer identify key features that make companies appealing for acquisition. Among these is an entrepreneurial spirit, a break-the-rules disruption mentality, ease of communication across lines of hierarchy, and of course, plain old just having a good product. As the cannabis market becomes saturated with new business ventures, make yours stand out by having it attractive from the inside out. This discussion will focus on ways both quantitative and qualitative that can demonstrate to larger ventures that you are ripe for the plucking. So, just a couple things. The industry is expanding rapidly, but as further regulations come into place, we'll see consolidation with this industry that are similar to any industry experience a wave of innovation and expansion. If you're not prepared for this, it is likely you will experience the effects of industry consolidation or ultimately eliminated. It is for this reason it is essential to consider an exit strategy before and not after the fact. So what is an exit strategy? An exit strategy is a plan designed to achieve partial or total liquidity to the shareholder either over time or on a date certain. As a shareholder, it affects you. Whether a majority shareholder, minority shareholder, or an employee, the exit strategy for your organization will dictate the timeline of your career within the industry. So the 5 types of acquisitions for exit strategies is employee buyout, merger, acquisition, succession planning, and public offering. So in the audience, How many of you have participated or are aware of the formulation of a corporate, So how many of you guys participate or are aware of the formulation of a corporate exit strategy for their organization? All right, just about as much as I thought. Okay, so this is going to be a great panel for you guys, because not only are we going to talk about mergers and acquisitions, but we're also going to touch on a couple other specific exit strategies that you can look at. So focusing back on mergers and acquisitions, for each of the panelists, give a reason why a merger or acquisition can be a tool for growth. Michael?
I think the biggest tool for growth with M&A inside of your own company is access to markets that you currently don't have access to. So, you know, if your company is acquired by someone who's in 100,000 convenience stores, instantly you have access to those revenue channels. And so, you know, you may be doing, 10 million top line annually, and getting acquired could be the best thing for your company, given that you now have the ability to sell into channels that you otherwise didn't have access to.
All right. Brandon? Michael? Everyone wants to start?
Well, we're looking for subject matter expertise in an environment where we don't have subject matter expertise, which is the natural foods consumer packaging space. So positioning our company with smaller retailers at the start as a strategy and ensuring that we get to know the consumers inside of those natural food store environments hopefully positions us to be an acquisition target, and therefore the benefit would be to get access to more of those.
But yeah, honestly, it's hard to stick to just one, so I'm going to nail out a few. Certainly, it's an easy way to expand into other markets. I mean, we certainly see a lot of companies that, like I'm based in Colorado, clients that started in Colorado, and now they're about to expand nationally. And so, looking for acquisition targets in other states is a way for them to expand more quickly. Another thing is brands. We have a lot of companies that are developing brands. And once you develop that brand, looking for, again, to expand that brand nationally, acquisition strategies are often, a good opportunity to make that expansion. And also technology. You may find a company that has some technology that's synergistic with what you're doing. And so making those acquisitions can often help accelerate your IP growth and your revenue growth. Derek?
Yes, I think these are all excellent points. Opening up new markets, working capital is obviously to expand what your current operations are, and bringing on like you said new technologies, and really if you can find an M&A or a partner that's not especially in this industry that's so hot and so relevant and growing so rapidly, that the money's there. The money is coming from everywhere, from every industry, from tobacco, from pharmaceutical, from cosmetics, from food and beverage, and the money's there. It's figuring out who's going to, what are the gaps in your team and the gaps in your vision, and who can help you get to that next step.
Absolutely. So, Brent, in what ways can a company position itself to take advantage of these strategies? What are the pros and cons of utilizing these different transactions?
Obviously this is mostly about mergers and acquisitions, but I would say certainly as an entrepreneur and if you're starting a company, it's super important to really from day one think about how you might want to exit, when you want to exit, and from day one build out your business plan and your financial model to reach that. In my opinion, being acquired in the future is probably the most likely exit, and it's also the thing that's, there's all this rage about going public and OTC stuff, which we'll talk about later, but most of my clients are getting acquired. That's how they're exiting. Often you can get a better valuation by doing an acquisition as opposed to a public offering. And it's just really important to get all your ducks in a row from day one. Hire good counsel, hire good accountants from day one, make sure all your books and records are straight, make sure you have all your compliance documents in line, make sure you're complying with all the regulations, make sure you have a solid team, make sure you have a solid financial model, and that you execute to your business plan. Because when I look at, I also represent a lot of investments, so I look at a lot of deal flow. And so for folks that have their ducks in a row, not only is it easier to get through the acquisition process, but also often drives a higher valuation.
So for the rest of the panel, what is the profile of companies that are most attracted to competitors seeking to make an acquisition or to propose a merger? Michael?
Well, I think the biggest thing is having a market differentiator. How many people in this room think that they do something better than any other company in the United States? Could be something small like water processing, could be something big like Derek, being the largest isolate manufacturer. But if you have a single competitive edge, that's essentially what you're going to be selling first. Everything else is totally secondary in terms of value.
Okay. Brandon?
We'll start right there.
Well, we're working hard to protect our IP. Use the mic. So we're working hard to develop and protect our intellectual property. So patent pending, a utility patent is pending. We're trying to move that through the process to ensure that that block is stable and secure. We talked about customer data, and we're in a position as an early stage startup where we aren't rapidly expanding into chains and responding to every inquiry as if we're going to get into that store. More or less, we're working with small test cases to get to know our customer really, really well, and have sell-through and velocity and all of these things that need to happen in retail. That has to happen before we expand. And then brand development is critical. So ensuring that just because we have this array of consumer sets that are coming through our customer service and retail channels at all times, really trying to strategically focus on just a few consumer archetypes that we know we can reach with a unique message again and again and again.
Derek?
Yeah, I mean, these are all, covered most of the bases. I think that, for starting your company, not only, what is it that you do very well and what's your differentiator? It's, are you, from the start, positioning yourself, creating efficiencies, and how are you more efficient than your competitors, and looking at it as a long-term play, not like, this week, this is the hot-selling product, or this is the market trend. How do you do something, better, more effectively, and how do you, are you able to scale that, and what does that look like, and really trying to carve out that roadmap.
Did you have something to add?
Yeah, I just want, differentiation is huge. This is a CBD conference, and I think the last number I heard was upwards of 5,000 CBD brands. And so how do you ultimately differentiate your brand from all those other competitors? And I often use the example of vodka. I mean, why do we pay more for Grey Goose versus Absolute, right? They probably cost the same to manufacture, but those companies have spent time building a brand, building a concept, building an idea, building an experience. So when you think about your brand, think about how it's going to connect with folks, because ultimately you're going to have to set yourself apart, just like people pay a lot for higher-end bourbon or vodka.
Do you have something else you want to add, Michael? You good? Okay. So before a company considers an offer, the company should know the components of valuation or the valuation of their enterprise. Brent.
Could you describe the various methods that companies can utilize when evaluating the adequacy of an offer to merge or to be acquired?
Yeah, so there's a handful of kind of core valuation methods. One is comparables. So if you're manufacturing a vape pen or pills and you want to sell your company, what are other similar companies selling for in the marketplace? The challenge there is that there's not a whole lot of deal history, and so getting that data is hard. There's not a ton of data, and it's kind of sparse. That's kind of challenging. Another method is what they call discounted cash flows, which is effectively looking out, doing your 3 to 5 year financial projection model, and then discounting that back to what that present value is. That's kind of tough because it's based on your kind of forecast, right? So you're having to kind of prove the value of that forecast. Another method is some multiple of revenues or some multiple of earnings. And that's, to the extent that you have some solid operating history, that's definitely a good tool to use. The challenge there is that, again, in the cannabis market in general, those multiples can vary widely. And I've seen valuations go from 1x of revenues up to 8-10x of revenue. Of course, it depends on what segment of the market that you're in. The other thing that's really challenging too is, as an investor, when I represent investors, when I look at companies, the companies that have their ducks in a row, immediately get a bump in valuation, and also to the fact that they've put in risk management procedures and they have records regarding compliance helps the investor feel much more comfortable about the valuation. But just the fact that we're still in this kind of gray area from the evolution of the industry, it just adds an extra layer of risk that makes it harder to really have an objective valuation. And ultimately, it's going to determine, or it's going to be based on how you, the company, and the investor kind of arrive at a valuation. So, having all, using these various methods, coming up with different data points, and getting as much of, actual objective financial data to support helps. But often it's just the final negotiation between the investor and the company.
The one thing that Brent didn't touch on is strategic acquisitions. So let's say for a smaller company, or a very small company, it could be a company of one person. Let's say you have a technology that could bring down Derek's cost of goods, from $2,500 down to $19. Now, if you extrapolate out what that value was by applying your technology to his supply chain, and he realized that he'd be saving $20 million a year, even though you might not be doing any revenue right now, and that technology could, over the next 36 months, generate an extra $60 million for his organization. Now your company has value as a company of one with no revenue.
That's definitely a great point. So as companies mature within this industry, at what time is it most advantageous for them to consider seeking or pursuing merger or acquisition opportunities? Is there a general benchmark? It's open to the floor.
When you're profitable.
Want to extrapolate on that a little bit?
I mean, it's different with every, you're obviously going to have, if it's an IP play, then it's a much different thing, but it's in this industry, so many people have raised so much money off of things that aren't working out or haven't worked out, and I think that coming out and creating a real business around it and bootstrapping it, or friends and family raise until you can show actual numbers and an actual demand for what the service or product that you're providing, then it makes the negotiating table a lot easier.
As an early stage startup, we're fortunate to be in a position where we can show profitability, but we have yet to prove out scalability. So it comes back to, even though there's good-looking financials and a good-looking model, how big can we get? And we don't know the answer to that yet, and that's one of the challenges we face. So, I think my partner and I would say, we're just not ready yet. We're incrementally taking on more money to build out more mature use cases, over the next year to 18 months to hopefully be in a better position from a valuation perspective to where it would make sense for each of us to exit.
Yeah, there's no hard and fast rule as far as number of years or whatever from start to exit, but I will encourage you. Always kind of be in tune with obviously how your business is growing, where you're going with the business, but also just be in touch with the marketplace, because things are changing so dramatically. You may find a great opportunity to exit in 12 to 18 months, and it's the right deal. Other times it's worth kind of waiting. If you're a cultivator in Oregon and you've missed the boat if you're trying to sell, because that the prices of Oregon weed has gone through the floor. So and just make sure you're in tune with the market and where your segment of the market's going, and try to find that sweet spot, and also just try to find the right partner when that time comes. Michael?
I would actually say there is one hard and fast rule, and that is it is the time to exit, or you should at least consider it, once you have two engaged parties. If you have one, you don't have a deal.
That is a good point. So going a little bit deeper into this, so on a scalability standpoint, when you start out your company, should that be definitely an idea you need to focus on? Because obviously if you can't scale, how are you going to build it to become acquired or merged? So where in that process should you start thinking about that scalability model?
From an entrepreneur's perspective, sure, day one, but it's often not the most practical road, because you may be going down a particular path and find out that the consumer didn't really want what you were putting out there in the first place. So I think it's really important to acquire the customer, then understand that whether or not that customer is going to purchase again, and then try to derive at the lifetime value of the customer and see that there's more and more and more of them. And we're in this position where we're at a seed 3 round, just raising over $1 million, and it's at that point where that investor has come in and noticed that we have repeat business, we have repeat consumers buying product again and again, that it is differentiated, and that they have now come in to help us scale, double our footprint, and position us for a future exit event.
Definitely a lean startup method. So would there be any other scalability? You were saying day one.
Yeah, so I guess when I think, again, I think it from a lot of times from the investor standpoint. I represent quite a few investors in investment funds. And when we look at investments, there's a handful of things that we look at. One, proof of concept if they're early stage. Second, have they thought about scalability? Do they have a strong management team? Is there technology? And have they been thoughtful about their financial model? And so, for us, for me, I want the entrepreneur to be thinking about all those items from day one. Because if you're not, I get proof of concept and I get, kind of testing the marketplace, but also be thinking about it. If you do get a solid product, but it's only going to sell, in LA, and it's not really going to be scalable, then that's, that challenges me from an investment standpoint.
I think that, when it comes to consumer side and scalability, it's something that even as much as you prepare for and plan for it, it's because this industry has exploded so quickly. Every company or brand, including the one I'm currently with and the ones I've worked with before, have all had a lot of growing pains. And I think you can have strategic plans in place, but as the market gets larger and your orders become bigger, and whether you're providing a service or providing a product, figuring out and trying to put a trajectory on how the market's projected to do $22 billion by 2022, which is absurd compared to what the numbers were in 2018. So how do you prepare your business, whether you're a CPG or whether you're a manufacturer, or whether you're a lab providing testing? How do you kind of prepare for that scalability? And I think you need to put as much time and thought in there as possible, because when you are looking for that for a fundraise or merger and acquisition, the infrastructure is incredibly important, and the leadership team, and having that roadmap and how you're going to take on those new challenges, those new orders is very, very crucial.
Well, you can read about this topic in my best-selling book, Tipping the Scale, found on Amazon. That is Tipping. Just kidding. So the purpose of the book that was written 3 years ago is really that given the organic growth of this industry, the average company in the CBD space will need to grow by 1,000% in the next 3 years to simply keep up. Now, if you're looking at being acquired, you need to show that you are an above-average company, obviously, and that you have the ability to scale by possibly a factor of 100 inside of the next 36 months. And so I would say the right time to think about scale is before you ever deploy a single dollar. Because if your strategy relies heavily on labor, your company will fail, because you cannot hire 100 times more people than are currently working for you now. And if you did, you can't manage them. And so, if you look at what our technologies are, we've gone, from 1,000 kilos a month to 1 million kilos a month of water-soluble processing in our facility in the last 18, 24 months. And that only requires an additional 1 employee. And so when you look at scaling by a factor of 10 or a factor of 100, I think you need to be able to do that with larger equipment, and not simply with more people and more pieces of equipment. And that's absolutely critical. So I would say, start before you deploy a single dollar.
So adding on to that just a little bit, so for acquisitions, how important are compliancy measures and certifications? when you look at being acquired? Are investors really looking into that, or are they just looking for just standard practices that are good across the board without certifications?
Well, I think the biggest investment that we've made as a company this year is into quality systems. We've spent over $1 million in labor costs developing comprehensive QC team. We have multiple binders that can stack up about this high with documents that we've compiled internally, just in case we get a knock on the door from the FDA. The nice thing is we also hired a quality manager that understands OTC regulations in Canada as well as all GMP regulations in Europe. And I think that as this industry is getting larger, you need to have a wide breadth that extends beyond the United States. And it all really starts with quality systems that enable you to enter those markets.
Anybody want to add to that?
You're not going to know everything. You can be the CEO of the company and not know exactly where you're going. So it's really important to surround yourself with good people. And we've been fortunate enough to attract a board of directors that's really talented and been there, done that. The founder of Yogi Tea, which is Whole Foods' top-selling tea brand in history. Folks at Danone and business unit operations directors over coffee creamers and beverages, and it's all about scalability. And it's just a matter of timing as to when you get beyond that proof of concept to where you can really focus in and hone in on scalability.
Yeah, I'll just add, and again, more from an investor standpoint, which could also be, if I'm an acquirer or a private equity firm that's looking to kind of buy you out, if it's a non-cannabis company, I can get my head around all the fundamentals and the analytics and do the research and all that. Once it becomes a cannabis company, there's a whole layer of other things that make me really, really nervous. Federal illegality, obviously on the hemp side, that's now federally legal. But still, the USDA has to weigh in, FDA has to weigh in, all the states have to adopt their programs. And if I find a company that hasn't followed compliance rules or have proper certifications, that's like a huge red flag for me. And so it's super important to make sure that you maintain all your compliance, all your regulations, all your records, certifications, et cetera, because that's a huge diligence issue from the investor side.
I think that the cannabis world, the marijuana world, and the hemp world are two extremely different worlds when it comes to regulations and what you can do or what you need to prep for raising money. I think the most important thing if you're looking to raise money or an M&A for if your business is already going is having audited financials. Outside of that, yes, you can have a CGMP facility, but that is really a CGMP facility is really what are those processes that are CGMP. And a lot of companies out there that are claiming X, Y, and Z certifications, really it has nothing to do with their those processes of the products that they're selling. So on the marijuana side, there's a lot of incredible and a lot of regulations that have helped the industry and set these standards that are necessary for the industry to grow. On the hemp and CBD side of things, those regulations aren't there yet. And for us, regulations will be our friends, and it will be our friend, and it will help set the standard and help companies that are legitimate and abiding by these rules to continue to flourish. As opposed to right now, there's every day there's a new news article coming out about we bought these 10 CBD products off of Amazon, and none of them have CBD in it. Or you walk into a store and 5 of the products that are supposed to be CBD products. Every brand is trying to stay relevant right now. Is for whatever reason is slapping CBD on their labels, and yes, it's an incredible raw material and incredible ingredient, but there's no, if somebody say this is 50 milligrams, a full spectrum capsule on a counter, and you test it and there's 2 milligrams in it, where's the repercussion for that, and who's going to be accountable for it? So I think. Yes, it's important to stay on track with it, and abide by these regulations and get your certifications. But on the, CBD side, they're just they're non-existent right now.
So when regulations actually do hit, and Wall Street and the banking industry fully entered these funding and finance arenas, how can small and middle market providers compete effectively in that environment?
Yeah, I mean, once the big folks come in, so right now, even, hopefully we'll start to see that on the hemp side. But once the institutional investors come in, I mean, I'm already starting to see some more sophisticated, larger funds come to me that want to deploy capital. And they're going to do real diligence. I mean, they're actually going to dig in deep. They're going to look through your financial model. They're going to look through all your contracts. They're going to look through your corporate records. They're going to look through your financials. And if they're audited, that's a bonus. It's starting to matter more. I mean, 3 or 4, when I first came into the industry 3 years ago, people were throwing money at marijuana companies and CBD companies without even doing any diligence and signing contracts. As more sophisticated investors come into the space, that stuff's going to matter. And so, again, having all your ducks in a row, making sure that financials are in good shape, corporate records, compliance records, all that stuff, it's starting to really make a difference as bigger and more sophisticated investors come into the space. Michael?
I just saw you grabbing for that mic.
Derek?
No, no.
No, you sure?
Yeah.
You just so much to prove, yeah. I want to hear Derek talk more. I would say, we've actually experienced something on a slightly smaller scale as a company, and that's going through an audit with a national retailer. And so you go through a similar quality audit to identify if the products that you're manufacturing are legal to sell on the shelves of any national retailer, legal to sell online. Because if you're not making your products in a compliant facility and those products can be taken off the shelves at any given time by the FDA, you don't have anything to sell. So I'd say making sure that your products pass all FDA quality regulations first, and then I think all of the financial components that Derek touched upon on the last question are also going to be critical. But as long as you have all your ducks in a row, I mean, that's something you can start right now that could take upwards of 1 to 2 years to develop, or things that you need to start now so you're prepared when that time comes.
Do you have anything to add there?
No, just start early, and as regulations are coming on, just try and make sure that your processes and everything is as clean, above board, and documented as possible, because getting these regulatory things and audits and whether it's your books or your facilities, it is expensive. And if you're a brand, your best bet, instead of trying to do all these things yourself, a lot of industries it doesn't make sense to be vertically integrated, and if you're trying to start a consumer product, go partner and go find the best your that you can that have these certifications and will get you the things that you need to to get your product liability insurance, to get your brand listed on gateways where retailers will pick it up and that sort of thing.
Yeah, there's a book called Behind the Cloud, written by Mark Benioff, that he's the founder of Salesforce, and he left Oracle, wrote this great book, and I think it's marketing tactic number 37 is for the startup is pick an enemy, and his enemy was traditional software. So coming from Oracle, where they had a model where they would sell software to big corporations for $250,000, a big package. He moved software to the cloud so little folks like you and I and the corporation can buy by the seat, right? So his enemy was software. And as a small business moving into this space with mostly dominated by players in isolate and trying to get down to this single molecule and sort of take on the traditional business of vitamins, there's opportunities for other businesses to kind of look at that model and move in the opposite direction and create unique niches in a space where most of the people are playing. If, as a small brand, the other book that I would point out is the Blue Ocean Strategy, where it's all the fish in the sea right now appear to be competing around isolating these single molecules and moving them into products where there's a growing consumer set who are more interested in holistic, whole foods, etc. And that feels more like the blue ocean to me, where there's not as much blood. And so having that strategy, setting those values in place, hiring the people that get behind it, we hope positions our brand as a differentiator to the question, small but strong, nimble, innovative when bigger players get into the space, and they may see value in that.
All right, so I got two more questions before we open it up to the audience. So, Brent, can you just briefly explain to the audience the pitfalls and advantages of utilizing microcap, penny stock, pink sheet, OTC, or exchange markets when considering public offerings?
Yeah, just a quick question. Is anybody here thinking about trying to go public through OTC or on pink slips? I just want to make sure it's, if it's not that relevant, I'll go through it really quick. So we do have some clients that come to us and want to go public, and my typical reaction is that's much longer play. And often it's a better time to stay private. It's much simpler from a finance standpoint. Oftentimes when you do get acquired, you can often reap more benefit than possibly going public. Although a lot of folks want to go public early, if you hit the pink sheets or the over-the-counter, I mean, the benefit is you can access the public markets. It in some cases can be easier to attract talent because they can get stock options that could be liquid, in the more near term. The downside is most of those stocks are super high risk. Well, there's different levels, and I can go into much more detail, and I can answer questions after this, but oftentimes those stocks are volatile. A lot of times investors come with those stocks at risk. Because they are riskier, the prices often can be lower. Volumes are small, and liquidity often is challenged. So we think one of the benefits of getting to the public markets is liquidity, but if you go public and you're on a marketplace where there's not a whole lot of liquidity, you can't always capture that benefit.
And I know, Michael, you wanted to hit on specific banking terms and some pitfalls for independent banking, correct?
Yeah, so if you start looking towards private markets, which is probably a more intelligent decision for everyone in this room, I think that one thing that you might not learn until you do it yourself is I think the structure in which investment banks commonly work with clients, and just being aware that I've seen a lot of companies absolutely decimate their value because of being handcuffed by the terms of their investment bank agreement. And so they've had a great 6 months of building collateral for the organization. They've done some outreach for that company to try and either sell it or raise money. They lose momentum. The investment bank loses momentum. And then, within 12 months, the investment bank is no longer really advocating on behalf of your organization. And now you can't raise capital or sell your company without a very significant fee to the investment bank for the contracted period of time in which they maintain exclusivity over your company. And so just a quick word of the wise is in the event that you do engage an investment bank, just make sure the terms that you're signing don't affect your long-term strategy, because, like I said, the average company in this room will grow by a factor of 10 in the next 3 years. And if you're above average, it's going to be a lot more. So don't leave a lot of money on the table to some investment bank that's not working on your behalf.
Yeah, so this is how it happens, right? I mean, as entrepreneurs, you're trying to raise capital, you're trying to ultimately sell your business. People come to you and they say, hey, I know a lot of investors, I can raise money for you. Or secondly, I know a lot of folks that could be potential acquirers, and I can go make those connections. Oftentimes, those folks don't deliver. But in the meantime, you find a contract for anywhere from 6 to 36 months where you committed to exclusively use them as your banker. And the companies get tied up, it's hard to raise capital, and to Michael's point, it can really shutter your ability to get the best terms out of your deal. So I definitely would advise getting good counsel if and when you come across those kinds of arrangements.
And when you're meeting with investment bankers and different banks, go and get as many offers as you can from people of whatever different tiered levels of investment bankers, and also ask the right questions of them and make sure that if they are, because there's a lot of advantages to working with them as well. They bring blue chip clients, they bring very strong introductions that you're not going to get usually typically otherwise for people now that the space has opened up so much. They bring a lot of value, and in addition to the pitfalls. But I think that the first offer that your investment bank is going to offer you, their first proposal, is far from what you should be signing. And make sure that if you don't have somebody on your team, hire great counsel to do it, or find somebody that you can have navigate your fundraise, because there's a lot of different terms and things that will be thrown into these contracts that are all very negotiable, And, it's, at the end of the day, it's your business, and, the only person that's going to make the right decision for it is you. And everybody's going to tell you what you want to hear, and you just need to make sure you've got the right people on your side advising you.
I'll throw one last thing, I think we're about to go to Q&A, but one last thing real quick. There's a ton of folks that are out there saying, hey, I can introduce you to some investors and help you raise money. Just give me a few points, we'll be good to go. Anybody who is transacting in the sale of securities on behalf of somebody else is effectively acting as a broker-dealer. And if they're not licensed, that presents risk both to that party and to the company. There's ways you can structure those things to minimize the risk, but everybody's trying to get a piece of this, a piece of that, and in most cases they're operating not in compliance with federal securities laws.
Any last points before we go? All right, so questions, anybody? All right.
Yeah, well, actually, to that very point, what are you seeing compensation-wise, first of all, with the investment banks that are wanting to come in, and also with some of these sort of brokers, whether they're acting, within or without the regulations? Is it across the board, or are they falling into some pretty specific types of patterns?
And I'll be curious to hear what the other folks have to say on the panel, but for the unlicensed folks, it can be all across the board. Somebody wants a point and a half, couple points, maybe up to 4 or 5 points. And that's across the board. A more traditional, if it's a legitimate investment banker, traditional ranges are 6 to 8%, and that can be 6 to 8% cash compensation plus 6 to 8% warrants, and then often you engage them for a 3 to 6 month what we call capital advisory contract, which is where they help get your pitch deck together and your financial model and your valuation and all that. So if it's a legitimate investment bank, 6 to 8% is certainly within the range. Michael?
On smaller amounts, just be expected. Legitimate investment banks, their minimums are usually around $400,000. So if you're only trying to raise $2 million, just expect that any top tier boutique investment bank, their minimums are probably around $400,000 for raising that. And so it actually might be the same amount to raise $6 million than it could be for $2 million. And in terms of percentage-wise, don't be shocked by that sticker if you see that those fees actually work out to be $400,000 to $500,000. So it's pretty standard to get the right people involved.
Anybody else have any points on that?
Yeah, so just on that point, if you do the math, a lot of legitimate investment banks won't raise money for anything less than $4 or $5 million. So if you're raising $2 million, it's probably going to be hard to get a high-tier bank to take your deal, because it's just not, unless they charge the $400,000, they typically just don't do deals that small. But you can still engage a lot of these folks. If they can't actually do the banking for you, they'll still effectively give you capital advisory services, which is effectively advising you through the capital raise process, which could also be valuable.
Pleasure.
First of all, I want to thank you, the panel, for sharing with us the growth and exit strategy of the companies. My question is related to the actual acquisition process. So the established companies, perhaps they can buy the smaller companies who have either intellectual property, as you explained, IP, or interesting products that can complement the established companies. But what would be the possible buyer of an established company in the near future?
It's obviously highly dependent on your type of company and who your potential acquirers might be. And so I think to my earlier point, as you're building a brand or a product or a service or a company, look who the big players are in 3 to 5 years that might acquire you, and start to try to see if you can build those relationships early on. But a lot of it is segment specific and what your goals are from a company growth standpoint. Is that? If I'm going to build out a dispensary, I may be calling Canopy Growth, because they're acquiring up a lot of stuff in that respect. If I'm building out a genetics company, who are the big players in the genetics field that may want to eventually acquire my technology or my patents?
You guys are As, again, back to the wearing the startup hat, we have a product and we have to pick a lane, and right now we're in 3 lanes. The product is served on-premise, the product is served at retail, and the product is an ingredient. The ingredient play feels really good. We want to be the NutraSuite of cannabis. So when we start to think about who's going to acquire the NutraSuite of cannabis, it could be the LaCroix of the future that wants that ingredient. So if that was the case, then we have to, scale an ingredient business, which is going to be different than scaling a consumer packaged good that's sold at retail. So that's why we're in the process of iterating, learning, and understanding who those consumers are, and then working with, obviously, people with experience as a solid board of directors and people in the industry who can kind of give us direction to that, fastest and earliest opportunity to have those conversations.
All right, so we have 4 minutes.
Hello? Can you guys share maybe some...
We can repeat.
We can hear you.
And
Yeah,
we'll
we can hear
repeat
you.
your question. We'll repeat it.
So if you guys can share maybe some aspects of the valuation on like the brand, like in sort of like the marketing side where like maybe you're more than just an e-commerce, like you're an education platform, you have tons of followers that just come to your site, or you have a ton of Instagram followers, or just a big following in general where you have marketing reach, like how do you value that?
Well, I don't know that there's a concrete answer, but I will just throw out and anyone is welcome to email me for this valuation template. We've gone through a fundraising round and we throw out a number, and the investor says, how'd you come up with that number? I send them a spreadsheet with 4 tabs on it that averages all of these methods from multiples on revenue to a subjective scoring system called the Berkus method, B-E-R-K-U-S, which is for a pre-revenue startup to use. You haven't made any money yet, you're not into revenue, but can you get this early stage investor, even if it's friends and family who know and love and trust you, you go through the exercise of placing a score on the leadership team, placing a score on the product, placing a score on any intellectual property, and placing a score on what you just determined. Look, I grew this following. I have this segment of consumers who I believe would adopt this product. And you apply that, and you come up with a number. And it's normally, under $1 million as a valuation for pre-revenue. But the same factor can be put into this spreadsheet to give a value for an established company that has, demonstrated social proof, if you will.
Anybody else got points on that?
Yeah, I think that if you're looking at what the value is of, say, if you have a network of influencers or you're putting out your social content strategy. Content marketing is obviously that's where the market's been driven to. I think the influencer marketing is been played out in a very interesting way, and really it's if you're adding value to whoever it is that's on the team and that's going to be leading that brand or that driving force, what does that conversion look like? If they say Dan Bilzerian, for example, for Ignite, every post he makes for Ignite, that turns into initially I don't know what it is now, but those first couple of posts were $250,000 to $300,000 posts. So what is that social network and proof of concept look like to you for your content strategy or that audience? Have you put similar products out, or have they promoted similar things? What has the feedback been from that, and what have the results been? And I think that would be a better, more accurate way to gauge what that audience is, what that audience is.